I think you're in such uncharted territory at the moment because remember, this is coming on the heels of many months of the administration arguing that the Federal Reserve should be cutting interest rates in accord with the political whims of the Trump administration rather than based on its very particular dual mandate, which is about inflation and it's about the labor market. And the fact that we have a central bank that's independent, that cares about those two things and those two things alone, is a really significant source of our economic security. The way I know that is because we have experimented in the United States, as have other countries, with Federal Reserves that become politicized. In this country, in the Nixon administration, we had Arthur Burns, who was pushing for interest rates to help President Nixon get elected. And the result of that was runaway inflation that increased from 3 to 13% over a 2-year period. So we do not want a central bank that functions based on short-term political whims. And I'm really worried we're moving in exactly that direction.
The Fed said they will abide by what the court decides. And President Trump yesterday also said he will abide by the same. But if the court decides that Lisa Cook can stay, are we past a red line? Like, is the damage already done when it comes to the credibility of the Fed?
Hope that the answer to that question is no. And I really hope that what's important to note in the context of the legal discussion here is that the Supreme Court has really gone out of its way in a case about removal that had nothing to do with the Federal Reserve to signal that the Federal Reserve is special and that these types of positions, because it's a quasi-private institution with a particularly important role in our economy, these types of positions are really only for cause removal positions. And frankly, for cause rises to a level in legal nomenclature that it's pretty hard to meet in the context of malfeasance. And so I think that the court has already signaled directionally that they really think protecting this institution and protecting its independence is immensely important. And I hope that that's what they continue to say as this particular legal case plays out in the courts. But the thing that I'm worried about is the sort of institutional credibility and the view by the markets and by the public and by other countries and other investors that our central bank is independent from any type of politicization. That's kind of a genie that you can't put back in the bottle. It's something that's taken decades and generations to build. And I worry that it evaporates pretty quickly as a result of some of the types of attacks that we're seeing. So I'm hopeful that the judiciary is going to step in appropriately here, but I'm still really disheartened to see the types of attacks that you've been seeing leveled at the Federal Reserve of recent.
So let's keep your law professor hat on for a moment, Natasha, and talk a little bit about the definition of for cause in this context. You touched on it, but I'm curious if, let's say, the allegations about mortgage fraud end up, and we haven't seen the evidence here, that we don't have that yet, but when it happened, if it happened, matters. My understanding is intent matters as well. So from a legal perspective, why don't you think this would qualify as a for cause reason?
I'm far from an expert on for cause removal, nor have I looked at the specifics of this particular case, and nor, frankly, could we have at this point, because Lisa Cook hasn't been charged with any crime or anything. This is a set of allegations that have been leveled at her by the president and by the administration. What I can say is that in the particular context of removal with respect to the Federal Reserve, the court has been pretty explicit that it thinks it's important, and you saw it in the statement that the Federal Reserve put out yesterday. These are Senate-confirmed positions with very long terms that run cross administrations, precisely to try and insulate this institution from exactly the kind of political pressure that we're seeing levied against it. And this isn't just about mortgages, nor what has it been about the renovation of the Federal Reserve building, which has taken a lot of airtime over the course of the last many months. It's very clear that what's happening here is really frustration with the direction of monetary policy, and that's really no place for the administration to be acting. In fact, it's frankly counterproductive to their goals of seeing interest rates come down and seeing economic strength be very significant in this country.
We're speaking with Natasha Sarin. She's the co-founder and president of the Yale Budget Lab. She's a professor of law at Yale Law School and has an appointment, too, in the Yale School of Management's finance department. I promised we'd go all over, so we're going to move from the central bank to really what I think a lot of the market is kind of moving past, and that's tariffs, because earlier this month, our team reported that the average U.S. tariff rate will rise to 15.2% if rates are implemented as announced. This is according to Bloomberg Economics. It's up from 13.3% earlier and significantly higher than the 2.3% in 2024 before President Trump took office. Just today, the latest, the president imposed a 50% tariff on Indian goods to punish the country for buying Russian oil. That's the highest tariff in Asia. I'm wondering how you're looking at the fraying relationship between the U.S. and India and what's at stake more broadly when it comes to this tariff.
Importantly, what we should understand, and my colleagues at the Budget Lab are hard at work, by the way, updating our estimates with respect to what happens to the effective tariff rate and what happens to the type of revenue that we're going to see coming into this country. But roughly speaking, you've seen about an 8-fold increase in the average effective tariff rate over the course of the last 8 months of this administration, bringing in about $3 trillion of revenue into the country over the course of the next decade. Importantly, and this goes a bit to your point, Tim, it's never been super clear to me what exactly the objective is of this type of trade policy and where exactly it is that the administration is hoping to land. Because part of what you've seen articulated is that this is really about sort of China and national security and being sure that our adversaries are held at bay. In that environment, you really are quite worried about the idea of alienating allies and being particular with respect to not just India, but if you think about Canada and Mexico and other countries where traditionally they've been very strong allies of the United States. And in fact, we've been encouraging of more manufacturing to shift, particularly to India and Vietnam, exactly because it shifts away from China. And so a little bit feels like this policy has been kind of inchoate and all over the place. And it's hard to analyze like exactly why it is we're doing what it is that we're doing in order to be able to try and judge any success. What I can say is as a result of the tariffs so far, prices are going up and going to go up further. The economy is going to be smaller. And it doesn't seem like a win from the perspective of the American consumer or from American businesses.
I'm glad you brought that up because I'm curious if you think this will undo all the years of goodwill that the U.S. and India have built.
Well, I think that I'm worried about, frankly, is that you are in a situation where we are very exposed to particular relationships that it's taken to, and this actually relates to our conversation about the Federal Reserve, in that a lot of this sort of goodwill that you're describing are things that it's taken decades across administrations to try and build the types of working relationships with our allies that have made us this global hegemon and have made us a real marker of stability in the economy, a place that other countries want to invest in and other investors, both domestically and internationally, are keen to spend time in and around. And so what you worry about in some sense is not just, are you alienating one particular ally, or are you moving us, sending some other countries closer into the arms of China? Of course, you're worried about all of that. But also, I think what you're worried about is the general sort of chaos of not exactly knowing where these tariffs are going to land, not knowing if it makes sense to try and shift part of your manufacturing supply chain into India, because if India's effective tariff rate is 50%, it's no longer the type of place where you're going to want to be pursuing a lot of that type of business. So I think it makes decision-making really complicated for the United States and for the businesses that are in this country. And it also runs real risks geopolitically that are pretty concerning.
I promised we'd go everywhere. We have a few minutes left, and I want to talk a little bit about the labor market and productivity in the context of record low birth rates in the United States, immigration that has come down quite a bit during this administration, and what it means for a workforce moving forward. How do you weigh those two things?
It's so interesting because I was actually talking to some colleagues or some friends who work at the Congressional Budget Office who have said that one of the reasons why you have productivity growth over the course of the next decade, that their estimates are going to average in the 1.82% range, GDP growth in the 1.82% range over the course of the next 10 years, is precisely because it's on the back of an increase in labor supply that comes from immigration. And the reason why that's so important is because, as you're describing, Tim, we have an aging population in this country, so a big chunk of people are going to age out of the labor force. It's really important that you have that supply coming in. In a world in which you don't have that supply coming in meaningfully and you've kind of shut down pathways to immigration, as you've seen policy-wise over the course of the last many months, you start to lose a very significant driver of labor force growth, and then you start to lose a very significant driver of productivity and broader economic growth. The thing that's interesting is it's happening at the same time as you're seeing potentially this productivity revolution that's coming from artificial intelligence. So in some sense, it's hard to know exactly how to disentangle those two effects as we watch the direction the economy is going over the course of the next many years. But restricting labor supply is going to have a pretty meaningful impact, particularly on sectors of the economy like construction and manufacturing.
But with AI investment booming, do you think that AI will be able to offset the lack of workers, whether in relation to immigration, the supply of workers that we have, or are we facing right now?
It's kind of hard to answer that question right now in some sense because it's hard to know exactly what to make of the very significant capital expenditure investments we're seeing in AI, and hard to know what to make about the role that AI is having in the labor force thus far. There's a great new paper by Eric Brynjolfsson and co-authors where they look at the extent to which you're actually starting to see displacement in the labor force that has to do with artificial intelligence and its growth and usage across different sectors of the economy. And they do find that you're starting to see, particularly for younger workers who are in the most exposed industries, you're starting to see actual impacts with respect to their possibilities of labor force entry. And so I do think that there is going to be an effect here that's meaningful. It's just really kind of early innings with respect to this type of productivity change and shift, and early innings with respect to knowing whether AI is really a complement or a substitute for other aspects of the labor force.
Yeah.